LLC, LLP, C Corporation, S Corporation, and Sole Proprietorship. This can be confusing, really. So if you are just like me, you are trying to understand this legal structures better and you want to know what's best for your small business, I want you to stick around till the end of today's conversation because I'm going to clarify everything for you. All right? Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous. If you are doing as terrific as I am, go grab a cup of coffee or tea or vodka and let's roll. Today's conversation is very simple. The differences between an LLC versus LLP versus C Corp versus S Corp versus Sole Proprietorship offer numerous advantages and disadvantages to each entity. So to determine which business structure will best suit your company, it's important to take a thorough look at the characteristics, benefits, and limitations of each type of structure. Let's first start with the S Corporation, aka S Corp. So for you personally, an S Corporation offers the same type of liability as an LLC. So the main difference between the two types of entities is the way you'll pay tax on your income. So S corporations are not legal business structures. They're not. So the IRS grants S Corp status to qualifying C corporations, and the change in status affects the taxation of the corporation's profit. And S Corps are actually intended for small to medium-sized domestic businesses. Okay, keyword domestic businesses, and an S Corp cannot have more than 100 shareholders. It cannot. Shareholders never pay, they never have personal liability for business debt, but they pay personal income tax on any dividends or salaries drawn from the business. And S Corps are not required to pay corporate taxes like LLCs. They are pass-through entities, right? Quote unquote, pass-through entities. In other words, all losses and profits go through the corporation's owner. And owners if there are several owners. As a corporation, however, an S corporation must perform a variety of bureaucratic duties to remain compliant, including issuing stock, passing bylaws, and holding shareholder and director meetings with accurate minutes. With an LLC, business income and expenses are accounted for in the personal tax of the business owner. With an S corporation, the company essentially pays you a salary, which you then pay taxes on as regular income. In addition, any extra profits are considered dividends, which are taxed less than they would be in an LLC. Consequently, in some situations, S corporation offer significant tax benefits. And S corporations have only one class of stock, and they must not exceed, as I said earlier, 100 shareholders. So I'm showing you on the screen here our recap of an S Corp, what you need to know. You can see that on the screen. We're going to leave it for a few seconds rather. All right, let's talk about C Corporation, aka C Corp. So the main difference between a C Corp and other structures is again the difference between tax options. An S Corp and an LLC have different ways of dealing with tax, but the responsibility for paying tax on the profits of the company stays with the owners. The C Corp and the LLC both offer limited liability protection for their owners. So C Corps have no limits on the classes of stock or number of shareholders allowed, right? If you remember, S Corp less than 100, C Corp there's no limit. To form a C Corp, a company must submit articles of incorporation. Shareholders purchase stock in the company as a form of collateral, and corporations receive favorable tax options when it comes to the ability to deduct expenses from company benefits such as health insurance, life insurance, and retirement packages. So these benefits are not considered income to the employee, so they are not taxed. As the IRS strictly defines employee, for an owner to be considered an employee, the business must be a corporation. Very important. And C corporations generally are favored by larger companies due to the improved flexibility provided in comparison to S corps. And C Corps may have unlimited shareholders and have different levels of voting privileges among those shareholders, making it easier for C corporations to actually grow and expand their shares. Like S Corps, C Corp shareholders must pay personal income tax on earned dividends, but unlike S Corps, C Corps also pay corporate taxes. And this opens up the possibility of being double taxed, right? AKA the concept of double taxation. C Corp shareholders are not generally responsible for any business liabilities. As a corporation, C Corps are subject to the same management and regulation compliance requirements as S Corps. And what we've seen in our research is that some banks and investors prefer to invest in corporations rather than LLCs. So securing funding for a corporation may be easier than other entities. So if you intend to seek funding from, say, a venture capitalist or make an initial public offering, an IPO in the future, forming it as a C Corp is your best bet. And the advantages of incorporations include personal liability protection, easy owner transference, unlimited lifespan, tax benefits, and in general, easier fundraising. Those are the pros. And the cons of incorporations corporation include legal requirements for meetings, filings, and bureaucracy, expensive formation requirements, limitations due to state regulations. In some cases, equity capital, debt capital, fundraising is more difficult. So we are showing you on the screen also the recap table of S Corporation, S Corp. You're going to leave it on the screen for a while. Now let me talk to you about LLC, Limited Liability Company. An LLC is a basic business structure that is actually suitable for many companies, including those with just a single owner or a few employees up to much larger companies. So you have a single member LLCs and you have multi-member LLCs. So the main purpose of an LLC is to remove personal liability for any debt or actions of the company. This means the company holds those liabilities itself. So when it comes to determining how it will be operated and how the owner's financial interests will be divided, a limited liability company is the most versatile of all the business entities, really, hands down. So when it comes to income tax, it can even choose to be taxed as a C corporation or an S corporation rather than as a sole proprietorship or a partnership. So remember that an LLC is actually a state legal formation. The concept of an LLC doesn't exist at the federal level. All right. And thanks to its flexibility, the LLC structure is best suited for owners who desire more options regarding the management and taxation of their company. So a limited liability company is a flexible incorporation option, but the option is not available to all businesses, nor are the regulations the same in all states. As I said, this is a state formation, so the structures and the rules and the requirements vary by state. Generally, the IRS considers LLCs to be pass-through entities. In other words, all profits and losses from the business can pass to the owners and be reported on their personal tax returns. LLC owners are protected from personal liability for debts or claims attached to the business, and this tend to lose only what they invested in the business in the first place. And LLCs essentially offer protection similar to that of corporation shareholders, but with simpler taxation and management. So I'm showing you right now our recap table on LLCs. I'm showing this to you right now on the screen. You can see it. The important elements you need to remember when it comes to LLCs. We're going to leave this on the screen for a few seconds. All right, folks, I will be right back right after this. Don't go anywhere. Welcome back, folks, to another session of the Awesome Sweetie Kiwi Show. We are still having a conversation. We're doing a compare and contrast between LLC, LLP, C Corp, S Corp, and Sole Proprietorship. And I want to talk to you now about LLP, not LLC, LLP, Limited Liability Partnership. Now, a limited liability partnership and an LLC have some core similarities, but the difference between them primarily relates to liability. In some cases, example, fraud, The owners of an LLC may be held liable for actions of the company, even if it was actually your partner who committed the fraud. As a company owner, you may still be liable. An LLP, however, may protect against this kind of situation as the structure limits the liability of each partner. An LLP has no limits on the number of partners that may be involved. Partners may be general or limited. And limited liability partnerships are businesses with more than one owner who all have limited personal liability for business debts. And LLPs are primarily used by licensed professional groups such as attorneys and doctors, and some states do not permit any sort of business apart from licensed professionals to form an LLP. Okay, so this is very important to understand. And a partner in an LLP is protected from personal liability in the case of debts or claims accrued by another partner, keeping personal assets from being used to pay for the mistakes of another. And LLPs are easier to organize and manage than a corporation, making them preferable for professionals who just want protection for their personal assets. And if you need help, if you need, there are a lot of resources on the internet in terms of understanding the differences between an LLC and an LLP. And one thing I want to say here is that we're going to put on the screen right now the recap table for LLP, so you can understand more about this. All right, let me talk to you now about the sole proprietorship. And this is also known as a sole trader or a proprietorship. This is actually defined as an unincorporated business which has no separate legal existence from its single owner. And in its modest form, a sole proprietorship is just a one-person business that does not have to be registered with the state as compared to an LLC or an LLP or a corporation. And people can automatically set up a sole proprietorship even without paperwork. The sole proprietorship is the easiest form of business under which one can operate, particularly from a tax and accounting perspective. All right, this is kind of important to know. Now, the business under the sole proprietorship refers to a person who owns the business and is personally accountable for its debt. So you probably are listening to me right now. Maybe 8 out of 10 viewers right now are sole proprietors. They're self-employed. So one can operate a sole proprietorship business under the owner's name or do business under a fictitious name. The fictitious name, the DBA, is the trade name of the business and does not create a separate legal entity from the sole proprietor. So no paperwork filing is needed if the owner uses his or personal name, but may need to file papers to indicate that the owner is doing business as, which is also known as a DBA form. All right. So one thing I want to say here is that because thanks to its simplicity, ease of setup, and nominal cost, the sole proprietorship became a popular business structure among individuals, subcontractors, consultants, and small business owners. The owner of the sole proprietorship business may only need to register his or her name and secure local licenses, and the owner will be set up for business. As simple as that. All right. Now, as there is no separate there's no separate entity under the law for a sole proprietorship business. Contracts are normally signed by an owner under his or her personal name. Even if the business uses a fictitious name, the owner will usually have his or her name written down in the checks issued by the clients. Okay. So under normal circumstances, owners of the sole proprietorship business combine personal and business property and funds. The business under the sole proprietorship usually has the bank accounts under the name of the owner. The name of the sole proprietor owner can be used for lawsuits, either sue or be sued for the business. And when the sole proprietorship earns an income, the owner technically earns the income. And the sole proprietor needs to report the sole proprietorship income and or losses, as well as expenses, by filing a Schedule C along with the standard form 1040. All right, so this is important. And the profit and losses are initially recorded on a tax form called Schedule C, and you also, if you are a sole proprietor, you also need to file a Schedule SE with form 1040. And this is the form SE helps you calculate how much self-employment tax you owe, and Yeah, so this is pretty much it. We're going to leave again the recap table of the sole proprietorship on the screen for a few seconds so you can see it. All right, folks, this is it for today's conversation. But before I leave, I want to show you a comparative table of LLC versus LLP versus C Corp versus S Corp versus sole proprietorship. I want you to pay attention right now on the screen here. You can see. So we have the business type, how it's unique. We have protections and taxation, as well as the drawbacks to consider. So LLC, you have a flexible management, no board of directors needed. You can have a single member, unlimited owners allowed. LLP, you need at least 2 partners. Flexible management needs a partnership agreement. C Corporation is great to go public one day. You can issue shares to founders, employees, and investors. Unlimited owners. Owners may get preferred stock, and this is recognized internationally, preferred by investors. An S Corp, how is an S Corp unique? It's better for a smaller corporation. You need to have 100 shareholders maximum. Owners can only get common stock, so this comes with voting rights. And for the sole proprietorship, it's better for an easy setup, no paperwork to start, and you may still need a DBA or business licenses to operate legally, and 1 owner maximum. The protections and taxation. So LLC, no personal liability, taxed once or twice depending upon the structure. Taxation structure flexible, 20% QBD. QBD is the qualified business deduction. This is available for LLCs. LLP, no personal liability. You can only file as a partnership. Is taxed once, 20% QBD available. For C Corporation, you have no personal liability. This is taxed twice, double taxation, right? And for S Corporation, no personal liability, taxed only once. And for a sole proprietorship, personal liability for business debts, and this is taxed once. What are the drawbacks you need to consider with LLCs? You have ongoing filings and fees. You can't go public. It's not recognized globally. May be taxed as a corporation. LLP, they can't go public. They may be taxed as a corporation. All right. They're not recognized globally, and some states need unlimited liability for 1 partner. For C Corporation, ongoing filings and fees, less management flexibility, board of directors required, more administration, strict rules on holding meetings and keeping records. And for S Corporation, you have ongoing filings and fees, less management flexibility, board of directors required. You have more administration, you have strict rules on holding meetings and keeping records, and all shareholders must be U.S. citizens or residents. And for a sole proprietorship, one of the biggest drawbacks to consider is that there is no personal liability protection. Very important to remember. Thank you so much for your attention. I really appreciate your attention. I will see you next time. But until then, remember, stay marvelous.